Hello, I'm Nathan Kubik, and thank you for joining us for the end of 2021 Transform Wealth Capital Markets Review. I hope that everyone is doing well and that you're having a great start to the new year. Today, we'll be discussing recent events, what we are currently observing in the financial markets, as well as a number of noteworthy influencing factors moving forward. After a discussion on potential impacts from those factors, we'll expand upon how we're positioned from an investment standpoint in a number of our strategies. So let's get started. We did experience a strong finish to 2021, followed by some volatility in the beginning of the new year. The markets have remained resilient and the economy continues to drive forward. The most recent volatility can be attributed to COVID, inflation, and interest rates. The continued theme of corporate strength and economic growth does appear to remain intact. Corporate earnings are forecasted to continue their upward trajectory, which, if true, will continue to pull valuation metrics in the direction of historical averages. Interest rates have begun to move a bit, but nothing overly dramatic has been seen yet. COVID remains a key component throughout the markets. We are still working through the aftermath implications, and while supply chain struggles are improving, they do remain a pertinent issue. The highly contagious but more mild Omicron virus has also had an impact on the economy and the markets. While we appear to be nearing its peak, this has been a drag on the markets and the economy. Here, we consider COVID and most recently the Omicron virus. In looking at the chart on the right, we can see that vaccination levels have increased meaningfully. As depicted in the blue line in the chart on the left, we can see that confirmed cases have skyrocketed over the past month or so. Fortunately, fatalities, as seen in the gray line, have not followed suit. They remain at similar levels to that prior to the Omicron spike. While not nearly as dangerous, this is a highly contagious variant, with forecasts expecting about 60% of the population to have contracted the variant by the time it subsides. Those forecasts are also targeting another week or two before levels start dropping. While this is an important market factor, it does feel like the market has indeed digested its impact, which is not necessarily the case when it comes to inflation. Long-term inflation implications remain a bit of an unknown. Supply chain issues are certainly at the root of some inflationary issues, which should prove transient as the supply chain issues subside. That said, COVID policy stimuli is also a part of the issue. Late last year, policymakers decided to make some changes, and we are now expecting 3 rate hikes this year, which we hope will be impactful in tempering inflation. To that end, while inflation remains an important factor going forward, the strength of the economy, corporate earnings, and consumers' financial health gives us reasons to believe that we will weather a limited window of higher inflation. Additionally, the job market is roaring, and the Great Reassessment continues to take center stage. Companies are diligently searching to grow their teams, and corporate layoffs are at extremely low levels. And individuals are leaving jobs for more rewarding and fulfilling careers. And this is occurring at below average unemployment levels. Looking at this gray line, we can see that our current unemployment level of 4.2% is well below our 30-year average of 6.3%. And considering the Great Reassessment occurring along with the significant level of job openings, we can conclude that we have an incredibly strong job market. And this strength has resulted in some wage inflation, which is something we want to continue to track closely as it can have longer-term implications. In addition to having an incredibly strong job market, the consumer's balance sheet is also incredibly strong. In the top right chart, we see that personal debt payments as a percentage of disposable income is quite low, and that the household net worth has grown dramatically. Consumer confidence levels are at healthy levels, and this bodes well for continued economic growth. And speaking of economic growth, consider the chart on the left, Here we see the recession caused by COVID, but also the rapid recovery. While we have not made it back to our historical trend line, we did close the gap by a meaningful margin. Now, let's look at the chart on the right. Here, we consider the S&P 500 corporation's net profit margin. While COVID resulted in a substantial margin decline initially, the pivots made by corporations during the pandemic have resulted in greater efficiencies and stronger business models, which in turn has resulted in stronger margins. Considering the prior trend line, corporations of the S&P 500 have skipped years ahead in profitability, which also helps support some of the market valuations we are witnessing. Those greater earnings are forecast to continue by the consensus of analysts, as seen in the chart on the left. As you can see, those increasing margins, or earnings, are expected to continue as seen in the light blue bars. For some time now, we have been talking about future earnings justifying higher valuations. As a quick recap, the idea has been that higher valuations can be justified today if earnings are believed to grow high enough in the not so distant future. This is exactly what we saw through 2021. In looking at the chart on the right, we see the growth of the S&P 500 in green. As you can see, earnings growth grew at an even faster rate as depicted in gray. The result is that valuation multiples declined as seen in blue. The bottom line is that corporate earnings are indeed growing into their valuations. And that is what is depicted in this chart. Here we look at the valuation metric of forward price to earnings ratio of the S&P 500. While we are still on the higher side of valuations, those expectations of higher earnings can justify today's pricings as a whole. It is our expectation that earnings will continue to grow as forecast by the consensus of analysts, and that valuations will come back down as those earnings growth forecasts begin to move towards normative levels. Now, while we believe the markets as a whole can justify their valuations, it is important to note that we also believe there are many overvalued companies that do not justify their valuations. Looking at this chart, we see there continues to be an extremely wide disparity in valuations within the 505 companies of the S&P 500. This chart weeds out the top and bottom 20% of extremes and considers the remaining 60%. This is certainly a wider level of disparity than typically witnessed, and we believe this is an opportunity for prudence and an increased focus on fundamentals to be rewarded. Before jumping into our equity models discussion, I wanted to take another moment to discuss the vast difference in performance between the US markets and the rest of the world. Remember that in each of our equity models, we do consider international exposures and that they are part of our targeted universe. That said, we have tactically minimized our exposure to the international markets for over a decade now. While most investors know the S&P 500, this index is not truly a representation of our equity universe of options. Yes, it has been the top performing index for some time now, but it is important to realize that this is not always the case. Here we consider the S&P 500 in blue and the rest of the world through the MSCI All Country World ex-US Index as depicted in purple. As you can see, our decision to avoid international exposures continues to be a rewarded decision for our investors. Looking at that same type of data through slightly different indexes and a different charting method, we see that for over 14 years, the US has outperformed that of the rest of the developed world. Here we see that the MSCI USA Index has outperformed the MSCI EAFE Index by 275% over those near 14 years. And this includes the period of the pandemic. In 2021, from a style perspective, large growth outperformed large value by more than 7%. This is a trend we have seen for many years now, and even more if you factor out the implications from the 2016 election. The earnings growth we have been discussing is certainly a big part of this, and we continue to feel that growth companies are positioned well going forward. However, going back to our slide on valuation disparity, there are some interesting factors to be aware of. Which style box a company lands in is dependent on a myriad of factors, but ultimately comes down to two key buckets. One is based on the company's projected earnings, the other is based on its valuation metrics. Obviously, the two are correlated, but the point I want you to take away is that companies that are expected to grow their earnings more are being rewarded with a higher valuation because of that expected growth. Given our discussion on disparity evaluations, I hope it's clear that the growth style bucket has the higher extreme of those valuation metrics. As you can see in the middle chart, growth companies have much higher valuation multiples compared to their historical average than that of value companies. In addition to there being a large disparity between growth and value companies, there's also a wide disparity within the growth style box. We continue to prefer GARPy companies, which is an acronym for growth at a reasonable price. In other words, we continue to like companies with nice growth characteristics that are not trading at enormous valuation multiples. Looking at the sectors of the S&P 500, we see energy, real estate, and financials as the top performing sectors for 2021. Our current overweights are in energy, financials, technology, and materials, four of the top 5 performing sectors for 2021. And those specific target weights can be seen here for our core equity model. We continue to have underweights in communication services, utilities, and real estate. We are in the process of tweaking a few of the underlying holdings in this model and feel good about our exposures as we move into the new year. A similar story can be seen in our dividend equity model. This strategy has an inherent tilt towards large cap value, and we do believe that these types of companies have stronger fundamentals and that their valuation metrics also remain relatively attractive to the market as a whole. While this model will not tilt towards growth like the core model, we are still looking for growth characteristics within the value space. Additionally, like the core equity model, we also continue to hold a defensive portion within this model to a buffer cap strategy as well. We are also aware of the implications of inflation and potentially rising interest rates on dividend-paying companies and are thoughtfully positioned with this in mind. On the bond side of things, we have been witnessing some upward movement with yields. As you are all aware, we have been positioned defensively from an interest rate risk perspective and have discussed the need for patience for the last year or so. We have discussed the minimal upside in yield for extending our portfolio duration and the corresponding interest rate risk associated with such a move. We have discussed the reasons for our current positioning as it relates to tapering and to interest rate hikes. While not overly dramatic, that positioning appears to have begun to be rewarded as interest rates have begun to move. So let's dive into that over the next few slides. As we've discussed, inflation has expedited the Fed's decision to raise interest rates and have called out 3 expected hikes in 2022. Many analysts are forecasting 4 interest rate hikes as opposed to 3, and there are some that believe it will only be 2. Time will tell, but all appear to agree that the Fed will be raising the Fed funds rate throughout this next year. Here we consider the FOMC estimates as well as the market estimates. Consistently, the overnight borrowing rate of the Fed funds rate is expected to increase. We have already seen a corresponding increase in the short end of the yield curve and do expect this to continue. Based on our current positioning, this is a good thing for our clients and offers us additional investment options in our fixed income strategies. As we've discussed, inflation is a primary reason for the Fed raising the short end of the yield curve. Worthy of note is that the U.S. is in a stronger position than the rest of the world to make this change. Looking at the chart on the right, we see that the U.S. is the only country that has relatively low levels of unemployment and pretty good economic growth. This allows the U.S. to be in the fortunate position of making such a move, where these other countries have a greater risk of compounding other innate problems. The chart on the left is also important as it denotes the expected decline in bond purchases going forward by the Fed. As we have discussed, this expected decline should increase the supply of bonds, and this could potentially push up yields as well. And the beginning of this is exactly what we have been witnessing over the past quarter. Here we consider 3 different maturities for Treasury bonds. Remember that other bond rates spread off of the Treasury curve, and that while we don't currently own these low-yielding securities, they are likely the best proxy for understanding what's transpiring in the bond markets as a whole. Here we consider the 2-year, 5-year, and 10-year Treasury bonds. As you can see, in each instance, yields have moved up by a relatively meaningful amount. Perhaps more importantly, during the last quarter, we see that the 2-year bond has moved up more dramatically than the 5-year, and that the 5-year has moved up more dramatically than the 10-year. While we do expect this trend to continue and believe that this continues to be a time for patience, this movement does reward us for our patience thus far, and more importantly, opens up some good options for positioning more attractively as we wait. So in conclusion, given all available indicators and economic data, we continue to feel cautiously optimistic about what the future looks like. While it is not likely we will have such a strong equity markets performance year as we did last year, we feel strongly about the companies we currently own and the way we are positioned going into the new year. We remain focused on potential risk exposures and are prepared to reposition should indicators shift further one way or another. Know that we are watching the markets and your holdings incredibly closely. We are continuing to position your portfolios in efforts to reduce our perceived downside risk exposures, with the intention of maximizing your risk-adjusted returns. As always, thank you for placing your trust in us, and please reach out to us if we can provide you with any additional information or clarity on the information presented today. Take care, and we look forward to speaking with you soon.